everybody to the Real Estate Investment Club for June the 18th, 2021. I'm glad that you're all here, and today we are talking about evaluating markets and submarkets. Really quickly here, I just want to point everybody to the survey that we have. It's in the chat for those of you who are here. For those of you that are on the recording, you probably won't see it. We're going to keep that open for one more week, and then we'll go through the results together as a group during the announcement section next week. Or actually not next week. It's next week next week. And then in 2 weeks, we have an official Intel holiday. All right, so let me share my screen here. I want to point people towards the resources that we have because I think a lot of people know about it, but a lot of people don't. We have a SharePoint site. So if you are interested in finding out anything about previous meetings or joining our chat group, here is the SharePoint site. I'll drop the link in the chat. But this is a great SharePoint site because you can go here and see previous video recordings. And I've just gone through and updated them so that all of our previous recordings up to 2 weeks ago are now present here. And of course, the best place to go and look for these recordings is to go to the previous speakers page. And this is our previous speakers Hall of Fame page where we have a picture of every person that has spoken at this club. In the order in which they spoke, according to the day on which they spoke. And you can go through here and look at the topic that they have. For instance, entrepreneur shares her story, breaking into the industry, or how to hire a virtual assistant, or investing in farms in South America, fix and flips in Indiana, tax changes related to the CARES Act last year, etc. There's lots and lots of good topics there, including some of the people that are actually Intel employees who have spoken. Here's Richard McGrew speaking on mortgage note investment. And today we have another Intel speaker. This Manasa is an employee at Intel, and she's also working on her real estate business as well. And she is going to share with us about markets and submarkets. So once you're done checking out the SharePoint here, clicking on one of the pictures, noticing that all their information like website, contact, the video link if you want to go see their recording, it's right here under the recording area. Just copy that and paste it into your browser, and it'll bring you to the video portal for that person's talk. And of course, as always, feel free to send me suggestions on how we could do this better. I love hearing from you guys. So with that, I'll turn it over to Manasa. Manasa, welcome to the group.
Thanks, Daniel. Thanks, everyone, for joining. That was super well organized, Daniel, all the speakers and the different topics. Great job there. So I'm going to start sharing here. Let me know when you guys can see my screen.
All right, we see your screen and we can see your slides.
Okay, perfect. All right, so Daniel mentioned I work at Intel. I've been here in Austin working with memory validation for about 6 years now. I work as a senior validation engineer. I have been in Austin for about, over a decade. So I'm going to share a little bit about me, and then I'm going to dive into the market analysis, submarket analysis, and the subtopics here. So going to about me, sorry, I started speaking a little ahead of the slide. I've been in Austin over a decade, and I just got interested in real estate as a source of investing because stock markets didn't really work out well for me. And I thought I should get more formal education. And I got my realtor's license about 3 years ago just to be able to invest on my own and shop for investment properties and, write my own contracts. And as I as I progressed in my investment journey, I landed on multifamily investing, and I joined a mentorship program, which led me to start my own investment company called Silicon Hills Capital Group, which is a commercial real estate investment company. It's only been a year. I actively invest through this company in multifamily with other partners and investors. I also have a podcast called The Real Path to BYOB, Be Your Own Boss. It's kind of a play on words to actually essentially like get to a point of financial freedom where money is not your boss anymore. And on this podcast, my focus is to inspire folks and also to stay motivated myself to kind of get to a point of financial freedom. So I speak with various folks from different backgrounds. I've spoken to doctors, pilots, engineers who started their own real estate business and have successful business going to kind of learn about their strategies and how they got to the point where they are. So that's a little bit about me. Moving forward. So today I'm going to dive into market and submarket analysis and as to who can use this information. I'm not sure if you folks are aware, investors are typically categorized into active investors, sophisticated investor, and passive investors. Active investors are those folks who are looking and managing their own properties, be it single family, small multifamily like duplex or fourplexes, or large multifamilies. So folks who fall under this category can use this information, and also sophisticated investors who have some investing experience but really want to like deep dive into market research to make sure they evaluate their risk versus return profile. They can use it. And finally, passive investors. When a deal is bought to them, typically all the research is done by the partners or the active team. And for passive investing, you don't need to deep dive too much into the data, but getting a generic idea of the market to make sure your risk is low always helps. So even passive investors can use this information to research the deal rather than just going by what the sponsorship team has to say about the deal that they invest in. And finally, this information, since it's not just for residential or commercial apartments, it can be used for any asset classes like office spaces or hotels, anything, because finally what boils down to is how the market performs. So what does market and submarket analysis mean? When you buy an investment or a property, that is essentially the supply side of the equation. And market or submarket is the other side of the equation, which defines the demand. And when you buy a property, even though if it's in great shape and it looks brand new, if there is no demand, you're not going to get a good return on it. So when you let's say you buy in a phase where the economy is doing great, then irrespective of like the demand, your investment might do great. But if you want to make sure that the investment is still protected even an economic downturn, you want to make sure that you're looking at data to evaluate. So that's why market and submarket analysis is super crucial to make sure your risk level is reduced and you amplify your return profile. With that being said, I want to emphasize that real estate is not just local, but it's hyper local. And for folks who have some real estate experience, if you kind of drive around and see just like when you cross one street or that 1 mile, you can see real estate change dramatically, like a complete change in demographics, complete change in rent profile, complete change of how the apartment looks. So when I refer to market, it's like the broader area, and submarket is essentially narrowing it down to just that locality. So both are equally important. All right, moving on to the next slide. Okay, so market analysis fundamental criteria. So here are some of the things I listed, which are the fundamentals of market analysis. The number one being, is it a landlord-friendly state? I'm going to go into what that means in the next few slides. Second one is job growth. Third is population, fourth is income, and fifth is we want to make sure that the crime rate there is trending down. Okay. What does landlord friendliness mean? I'm going to go into all those details a little bit on the next slide, but here I have a map showing all the states across the United States. And what this is showing essentially is how landlord friendly or renter friendly states are. So if you look at this picture here, red is landlord friendly and green is renter friendly. So if you're investing, you might want to be here, but if you're renting, you want to probably be on the other edge. So if you look at the map, Arkansas here is the most landlord-friendly state, and there are other states which are in green here probably, which are more renter-friendly. Texas, where I am, is probably like here, a little bit landlord-friendly, but not super high compared to Arkansas. So essentially, this refers to what the state laws are and how they compare to or favor the tenant or the landlord. The next slide. So to explain this a little better, let's say we have two renters, Arnie and Vinny. Arnie in Arkansas, which is a state which is super landlord friendly, and Vinny is in a state which is renter friendly. So let's see what happens when both these people are running into issues. So in a landlord-friendly state, the tenant cannot withhold rent if his landlord fails to provide essential services. Because what happens in these kind of states is the laws that govern the rental payment versus the providing the essential services fall under different codes and different laws. So the tenant cannot withhold rent even though the landlord is not providing services. And if they do withhold and the landlord ends up going to the court, the judge will favor the landlord and not the tenant. The tenant will first be asked to pay rent and then take his other claims into small claims court, which is a different court after paying the rent. Versus the same scenario in a tenant-friendly state, the tenant can actually withhold rent because the landlord failed to provide services. So this is more of a tenant-friendly state where it's possible for the landlord to run into losses. And although this might seem like a very ethical reason here, what happens is when you have a tenant profile that cannot pay or do not want to pay, they come up with random excuses like there's some maintenance issue, like all of a sudden, because they don't want to pay the rent and they start withholding the rent, which can be a loss to the landlord because you can have tenants coming up with random excuses to evade paying rent. Going on to like some other descriptions or differences between a renter-friendly versus a landlord-friendly state, here is another one. So in a landlord-friendly state, the tenant essentially has to wait for the landlord to fix everything, whereas in a renter-friendly one, the renter can himself and cut it from the rental paycheck. And the other one is as far as raising the rent, in the most tenant-friendly state, again, which is Arkansas, like I mentioned, the landlord does not need to give the tenant any notice to raise rent. Whereas in other state, you need at least minimum 60 days notice for the landlord to raise the rent. Finally, as far as eviction in a landlord-friendly state, once the rent is not paid, there's only a 5-day wait, after which the landlord can go to the court and immediately get an eviction notice. Whereas in a tenant-friendly state, it's much longer, and some states like California, the eviction can go on for up to like 6 to 9 months, which is a huge loss for the landlord because if a couple of tenants end up doing this where they're not paying rents and they have to be evicted, this can really eat into like the cash flow of the landlord and extend the process. So saying that there is something called cash for keys, which landlords implement in states which are tenant friendly. Well, because they cannot evict them immediately and they have to wait for about 6 to 9 months, what the landlords implement is they reserve an amount of money aside and they pay the tenants so that they just leave because they are not losing rent for over a longer period of time. And this is called cash for keys, which is extremely common in states that are more tenant friendly. Doesn't want to just keep running into losses because he can't evict these tenants who can't pay. All right, so that's a little bit about landlord and tenant friendly states. Moving to the next slide. Okay, the other aspects that we talked about as far as market analysis are jobs, income, household growth. I'm going to share a lot of free resources which you guys can look and use to research your own markets when you're investing. The first one being jobs growth report is published by this institute called Milken Institute. Let me quickly pull up that report and share that. Okay, so here's the report, Milken Institute. This is a free resource that you can use. This report is published every year and it lists the best performing cities, and it also lists all the cities. If you go to the index here, okay, let's go to the index. So this is the index. It lists the best performing cities, and it also lists the complete list of all the large cities that have performed well, which is essentially the job growth list. So if we go to Milken Institute is it's a big data company, reliable. They publish this report here, so it's very reliable. It's used by a lot of commercial asset investors, so it's a very reliable report. Let me see, going to page 24. Okay, so list of all the big cities. So you can see how the cities have changed. Like this column here is 2017 to 2018, the ranking. This is the 2018, this is 2020. So essentially, if you want to invest, you want to target cities that are better performing in 2020 versus 2018. So let's look at the rank change. So if you scroll through this column here, this city, Palm Bay in Florida, was at 57 in 2018 and it jumped to 10 in 2020. So there is something going on. There's a big job growth happening here. So this might, if you're trying to invest out of state, this might be city to research. So you can scroll through the list here, or if you have a specific city in mind, you can just go and see if the job growth is in a favorable trending upward profile on this list. So this is one report to check jobs growth at. The second one, city data. So here you can look at household income and crime rate. Let me show you city data. Okay. So city data, this is the website. You can go to any cities here. There are all the cities, states listed. So let me just pick one state, maybe Texas. Texas, let's pick, I don't know, let's pick a city, Austin. Okay, so if you go here, you can see what the median resident is. Median income. So this is an important factor. What is often median income compared to Texas? You want to make sure that it's high enough compared to the overall state, because that if it's not even comparable or less than the overall state, you might want to go to a different city than the target city. So that's the median household income, then median value. So you look at all these for a bigger market level analysis. And finally, if you come down here, this is also useful for checking crime rate. So ideally we want the crime rate to be trending downward. So if you look at this columns here, 2006 to 2019, city data crime index, it was 434 and it's 302. So it's trending downward, which means the city officials are doing a good job. It was slightly increased from in these 2 years, but ideally over the larger span of a decade, it's like trending down. And overall, compared to the US average, if you look at this bar graph, Austin is still higher compared to the US average, but overall trend is still downwards. So this is how you check the crime rate. Bestplaces.net, this is another resource which is super useful to check property tax. I will share some free resources that can check property tax and percentages. Bestplaces.net. In this you can check the population. So here I just pulled up Boise, Idaho. You can check the population and how much it has changed in the last decade, which is good. There's an increasing population here, median income, age. Comfort index is essentially referring to how comfortable the climate is, median home price. And if you come down here and check on housing stats, let's see, housing stats. All right, housing stats. So here you can look how many renters make up the population. Anything more than 40% is actually good, this is 38%, which is not too bad, but 40% is better. And it shows the home appreciation here and how much the home appreciation was in the last decade. So if you further come down on this, it will show you how many people are renting, vacant for rent. So this is in comparison to the US average. Sorry, I'm looking at the chat, but I'll keep going. So you can look
Manasa, would you like me to monitor the chat for you and I can bring up questions?
Yeah, sure. That'll be great.
Yeah,
Yeah.
I'd like to do that.
Okay, perfect. Thanks. Sorry, I think I lost the city data. Going back. Okay. So you can look at this data of whatever city you're targeting and compare it to the United States average. Ideally, like housing vacant. This is 5 point. This is 12.2. Tax. One asked about tax rate just now. This is at. I think this is per square feet 8.5 versus 11. Property tax. This is all average. When we dive into submarket, that's when you like really focus on your particular investment. This is just giving you the whole state average. But here you can compare the market versus the United States, and obviously that's a better idea of how the market is to enter. Okay, moving on. That was blessedplaces.net and Yardi Matrix report. Yardi Matrix is a huge commercial data asset class data company. You can really download these reports from their website. They're published reports every quarter, I believe, and annual reports talking about different asset classes in different markets and how they perform. So this is another free resource you can go check out at your convenience. I don't have the report downloaded, so I'm not going to share that. Okay, the other thing to check is demand. If there demand, you can look for this in this website, weareapartment.org. It's a really cool website. Here I have it pulled up. Okay, so if you pull up, you can look at national, state. There are all these other states by metro, by district. I'm gonna go to metro and try to pull up a city I know, or San Antonio. Okay. So in this weareapartments.org, it's essentially showing you how many apartment residents are there and how many apartments were built before 1980, apartment homes, and you can see how many new apartments are needed annually, which shows you demand. So if you are investing in like a small apartment, like a duplex or a fourplex, this market might be a good one to enter because there's actually a need for apartments on, annual basis. So this is apartments.org. Job growth by states. Let me pull this up. Department of Numbers. Okay, so this website is government, and you can check on a monthly basis if a particular state has job growth or not. So this is published, like you can see all the states here, and they publish like what is the change of the jobs added, jobs change percentage, and you can go and target markets where the job growth is significant. Well, this is 0.4%. So you can just scroll through, like Hawaii was 1.81%. So you can look through this list and target markets where the job growth. So that is job growth by state. Economy at a glance, this website's down for some reason, so I'm not going to show that. Census website, 1 second, let me pull this data census. Data dot census.gov. Okay. All right, this is another useful website where you can go and check like based, this is also published by the government. It's a free resource, obviously. You can check total population, median household income for different states. You can pick state that you want to target and check how that state is doing. Like, let's say if you want to invest somewhere. This is the scale. So all the states that are in the deeper blue are the better performing states, obviously California and then Texas. So let's say if you want to target like Tennessee, it's not so well performing. So, if you're investing here, you should be careful as far as like what amount you spend to make sure you have enough return. So you can go and navigate to any state and see the income. And there are also other different sources like population, employment stats. You can just browse through all these content on your own, but that's another free resource. IRR report. This is a very reliable report, one that's used by several commercial. It's published every year. It's done by a company called Integra Realty Resources. Let me pull up that report. It's a super useful report because it talks about market cycles and where each each market is in the cycle. So if you are aware of how market cycles are defined in terms of growth, hypersupply, recession, this report can be very useful to read. Let me just go to a random page and show you what that means. So in terms of market cycles, there are typically 4 cycles. You have expansion, hypersupply, recession, and recovery. So this report, which is published every year, tells you essentially where each market is in this cycle. And it publishes this for all asset classes. For example, the one I'm showing here is for office market cycle. And here, if you just take Austin as an example, right, it's in the expansion phase. So if you are an investor, whichever type, active, passive, sophisticated, and you want to invest in office space and market, you have to, like, once you look at the idea that if Austin is in this expansion phase, your returns can only go up to, like, there's a lot on, like, because before it gets to recession. So you can time your investment accordingly. Versus if you're investing in some other market like Chicago that's in hypersupply, like, it may not be so much. So you can target cities for each asset class and figure out if it makes sense from an investment standpoint by looking at this report. I'm going to move on. I hope I'm not going too fast. Crime rate, which I defined earlier, this was from city data. So you look at that report and make sure that crime rate is trending down, which is an essential factor for market analysis. Because if your crime rate is not trending down, even though your asset is great, you won't be able to get the right people, on the demand side. There won't be enough demand to rent it. So making sure that crime rate is trending down is a very important factor for market analysis. On this, I want to share another website that's really good for checking crime rate. It's called map.org. I'm just going to pull it up and start sharing. Okay, justicemap.org. So in this website, if you can go and click advanced mode. And once you click advanced mode, you can look at the resolution by county, tract, block, or default tract is idle, because you can really deep dive. So I'm just going to county or city. I know once again, I'm just going to go into Austin, and you can look at all these different categories: income rich, income poor, income chain. So essentially, if you deep dive like here, it will tell you how, like if I take income, it'll show me the neighborhoods which are income rich and which are income poor, and give me a better idea about where to target in this submarket. So this can be used to going deeper into submarket level also. Okay, that is another free website you can use. Moving on. All right. Primary, secondary, and tertiary markets. If you have a little bit of experience with commercial real estate and heard the formula cap rate, essentially cap rate is inversely proportional to the purchase price. And cap rate is a very important aspect in defining how the purchase price, like where it stands. And as far as markets are concerned, primary markets are like the big cities through which we have international folks entering into the US, like San Diego, Boston, New York, Miami. And in terms of cap rates, you always see like the primary markets, which is in dark blue here, they don't see a huge change in cap rates. It stays in a closer, tighter range, which is about 1 to 2%. So which means indirectly, when the market crashes or if there's a market upswing, the price in these primary markets doesn't vary by a lot. So that's for the primary markets. The definition for the secondary and tertiary markets is not crystal clear, but secondary markets are growing markets like Austin, Dallas. And in these markets, which is represented by this other color, deep yellow here, you still see like a higher range of the cap rate, which indirectly means price. When the market is doing better, the price goes up. When the market is bad, like you can see a dip, but it's still not as bad as the tertiary market. Tertiary markets are where the markets are like in smaller cities, and you can see a huge change in cap rate here. When the market does well, it goes up, there's a huge upswing, but when there is recession, this is a market where investors have to be real. It really drops dramatically. You can see a big dip here. So in terms of risk, like primary markets are safer just because they're in a tighter range, and tertiary markets are just more high risk profile. Okay. Investors have to be real. It really drops dramatically. You can see a big dip here. So in terms of risk, like primary markets are safer just because they're in a tighter range, and tertiary markets are just more high risk profile. Okay, moving on. Okay, Tapestry, this is another free resource which is used by a lot of investors. Tapestry is a super sophisticated free data resource that helps investors in real estate make decisions, because it deep dives into lifestyle choices, what people are buying, how they are living and spending their free time. Like the stuff I mentioned here is a little bit more about what they do. So essentially what this website is if you want to invest, or if you want to start any business or buy a franchise and you're trying to figure out a location, this looking at the population that lives in that location helps you identify better if it's a match or not. So let me take you to Tapestry. Okay, Tapestry website. This is how it looks. ESRI is another data company. It just collects a lot of data. It's a statistical analysis company that explores about lifestyles, which helps investors make location choices. If someone wants to type a zip code in the chat window, I can try it out to check what Tapestry defines the folks living there as, and based on that, what businesses are suitable for that area can be decided on. Okay, 97229. Let's see, 97229. Okay, so Tapestry defines these folks as professional pride. The definition here is, click more details. I'm just gonna go in. Professional pride. Households, that's a huge number of households. Average household, 3 people, median 40, median household income 138. So deep diving into the neighborhood, typical owner occupied single family homes are in newer neighborhoods, 67% of units in the last 20 years. And who they are, consumers are well-educated career professionals that have prospered through Great Recession to maintain the upscale suburban lifestyle. So just details them into latest home trends, including finished basements equipped with home gyms and in-home theaters. So, with these details, if you want to start a franchise, another business, or start anything else, this information can be used for targeting that business for the location. This is just more information on what the particular group of people living in that zip means of life mode estates. You can just look through this information by yourself. And then lastly, you can see as far as where is the highest concentration of people of the similar mindset or lifestyle choices. It shows you across the US where they are living in the different states. So that's Tapestry. Moving on. Okay, market cycles. I spoke a little bit about this, but just to give you a little bit more insight into what market cycles means. Essentially, market cycles is a graph that has been defined by Dr. Glenn Mueller. He is a PhD in market economy, and he publishes this report or this graph every year by using a lot of data. I think 50 data points, if I remember correctly. So what this is showing is this is the recovery phase. This is the second quarter, is the expansion phase. Third is the hyper supply. Fourth is the recession. And as you can see, when the market crashes, this is always a shorter phase compared to when it's rising. And if you're an investor, it's not 100% accurate, but you can tentatively say based on his publication where a market is. And if you're investing in the market here, you have a long way to ride to be able to encash or get returns on, versus if you invest when it's in the second quadrant, it's a shorter ride up slope. Versus if you're investing here, then you have to be prepared for a crash. So it's really important to see where a market is overall on the cycle before you make your investment choice. And the report that he publishes every quarter defines where each market is in this quadrant. And this is not a one-way chart in terms of time. Like let's say there's a market in cycle or somewhere here at the edge, it doesn't necessarily have to go into hypersupply. It can swing back sometimes. So they collect data based on job growth, population growth, and publish this report every quarter for each city. So this, I just added this here. This was published in the last quarter of 2020, showing apartment market cycles. This is for multifamily asset class, showing where each the major cities are in this cycle of the quadrants. Like, some cities like Houston, they're in the hypersupply phase. So you can just make better investment choices by looking at this report. Okay, moving on, submarket. So what we talked earlier is market, which is like the bigger picture. So before you decide to invest in any state, that's the data you look at on a very high level. But like I said, real estate is not local, it's hyperlocal. It can change within a 1 mile radius completely, like totally, completely. The rent profile, the renter profile, jobs, everything is changed. It's within like a 1 to 2 mile radius. So it's super important to look at submarket analysis in that context. And for this, what we look at is rent comps, household income, a much deeper dive into the crime rate, percentage of renters versus homeowners, diversity of job industry, and gentrification. If you're not familiar with what gentrification means, it's essentially the process where like a high-end business or more affluent neighborhoods come, changing the profile of a certain neighborhood, causing the other assets in the neighborhood to appreciate. So it's important to see if there's, like, when you're investing in a submarket, if there's some business like planning to come there, which can completely change the value of the other investments also in that area. Okay, rent comps. There are a couple of resources here. Not all of them are free, but I listed them. For commercial asset classes, you have Yardi Matrix and CoStar, which are both paid. MLS for single family. If you're looking for single family investments, your realtor can help you get that. And Rentometer is a free resource. You can just create a profile and check for rent comps there. And what I mean by rent comps is essentially like, let's say you have your asset which you're planning to invest in, like here in this case multifamily like Cedar Run. So you compare the per square feet price of that against all the neighboring apartments in that area, starting from the closest to the farthest, and you see how much their scope there is for the rents to increase. So in this case, 0.99 was the per square feet price here, and the highest in that radius was 1.2. So this is an important factor to check if you have the scope to increase rents, which in turn means you're getting a better return on your investment. Household income. Okay, this is the rule of thumb. Essentially, the rent should be 1/3 of the monthly household income. So when you're picking a submarket, and you see like the rents are let's say you pick a submarket and the household income there is 40K, which means monthly income is about 3.3K. And if you divide that by 3, 1.1K is the rent affordability. So now let's say you are considering an investment property in that area, which is renting out currently at 700 or 800. Which is a good thing because that means you have a scope to increase the rent by $200 if it's at, or $300 if it's at 800. So affordability is household income. If your rent is low and you're entering a market where the affordability is high, you have a higher scope to increase the rent and get a better return. And typically for class B and C multifamily classes, like this is what we kind of target. More than 36K is better, higher than 40K is even better. What happens if the rent is less than 36K is we run into eviction, delinquency issues, renters just running off at night, not paying and stuff like that. So you want to make sure the income is 3x the rent at the minimum. The higher it is, the better, because it just gives you more scope to increase rent. Okay, moving on. Crime rate. I showed earlier about the market analysis crime rate in a particular state. We want to make sure that the city, we want to make sure the crime rate is decreasing. But at the same time, when you come to submarkets, there can be pockets of neighborhood where the crime is super high, even though in the overall city, the crime is low. So for crime rate, we have to just do a deep dive, and there's citydata.com is the one I showed earlier. There are other websites, Trulia, spotcrime.com, where you can dig in and really check the particular zip code and the area around your investment property to make sure the crime is low. And the main reason this is important is because once the crime is high, it's difficult to increase rents. I mean, no one wants to move to an unsafe neighborhood. Also, even though your property is super nice and you have spent a lot of money renovating it, what happens is typically you cannot change the demographic of the whole place. You can change some things, but you can't completely change people who are living in that area. So you don't get the return you would want to. So crime rate is an important factor to check. The other one is percentage of renters versus owners. This is an important factor, and ideally we want to be at 45% renters so that we have enough pool of people who would want to rent the investment property. 80 to 90% is quite high, because what happens is if there are too many people renting, that neighborhood might be a little shabby. There may not be enough people owning, the pride of ownership, the clean maintenance, that look and feel will not be there if they're like only renters in that area. So ideally 45%, but less than 80% is somewhere where we want to be in terms of renters versus owners. And the US average renting percentage is at 36. You can look at this data once again from the websites I shared earlier, US Census and Yardi Matrix. That's all the data I had to share. If you guys have any questions, I can take them, or if you want me to review any other slides, I can go back.
So we do have a couple of questions.
Yes.
And let me scroll up to it. First of all, the first question, is there any, this is from Collins. Actually, let's go one more up to Jordan. How reliable is this source? And I think I would apply that to just general web sources. And how does it get its data?
So some of these sources are government sources. Some of them I shared are commercial, like data companies, which commercials and sophisticated big institutional investors also use. Obviously, if you want super accurate data, like this quarter data, those are paid resources. But for the sake of investment and to get a more market, like bigger picture, I think these are very reliable, because these whatever I shared is pulling data from multiple resources, and a lot of investors go to use them.
Yeah, I would even add to that web sources, at least the way that I tend to use them, are always the first place you might look. But then if you have paid resources, or if you have a lending broker or other professionals, property manager, you can talk to them and get information about the areas too. All right. Next, are there any resources for getting statistics on property taxes?
Oh, the one I shared, I don't remember which one had percentage property taxes. I think
city data does.
City data, and also each county will like you can go to every county website, and that will have property tax information. I know it's a different website for each, but you can just look up the county. It's a free resource.
I dropped a link into the chat called countywise.com that just has a list of all the counties in the US and a link to all of their public government sites. And you can go to the treasurer or the assessor or the recorder and usually find that information. Most counties do share that information publicly.
Yeah, it's a free, every county should have a website. I mean, yeah, you can just pull it up.
Yeah. Let's see. Great information. Can we request that the organizers share the recording immediately? Yes, I will do that. Top 5 growing cities based on your analysis.
I didn't do an analysis. This is just something I fall back on when I'm looking at properties. But it essentially depends on you. If you're interested in certain markets, I mean, there's so many states, right? And if you're interested in certain markets, you just go and deep dive if it makes sense. And ultimately, submarket is also an important criteria, not just market. So it's just your own personal choice. Like you have to do your own research. I don't want to make any recommendations.
Yeah. And there are sites out there that do that sort of ranking.
Right.
Go to Marcus and Millichap. They've got free reports that'll rank those sorts of things.
And there are certain cities in these reports too. I just don't remember what they are, but you can pull them up and look for yourself.
Let's see. Another question is there a place to check for housing starts or housing permits? These can provide a window into future supply growth.
Sorry, I didn't follow the question completely.
Just where can I find out how many new housing permits there are and what are current housing starts? So building permits.
I don't know. I've not seen how. I think housing that's more like restricted data. I don't know. I haven't seen a resource that shares that publicly. I might have to research that one. I don't know that.
Yeah, I don't know of a public source either. We pay for CoStar, which provides that data, and I know Yardi does too. I know you use Yardi Manasa.
Yeah. I don't know
but I
if
haven't
free
seen it publicly.
resource. Right.
All right, let's see. Tell me if I'm missing a question here. Great information. Are there any free resources that will tell us what the cap rates are in a particular area?
You can just Google cap rates for a particular market, and Google will like show you what the cap rate is, the current cap rate is. I think I'll have to see up a free resource that has all the city cap rates. I don't know, or maybe one of these reports does have. I just can't think of it, like which one might. I can get back to whoever that is, or they can ping me separately, and I can chat with them to find them to that.
Yeah, cap rates are a little difficult because a cap rate is the ratio of the value of the property to the amount of income that it produces.
Right.
And the value may not necessarily be known if nobody's selling it, right? And the income might not be known because it's private.
But there is like a generic cap rate that's defined for most markets, like most big markets. Yeah, it's like just like a rule of thumb that might change here a little bit here and there, but those are kind of defined.
Yeah. CBRE has a map that gives some cap rate information, and you can search it and you can limit it by property type and then class A, class B, class C in the market tier. But cap rate data in general is kind of spotty and a little, it's not it's not an exact figure.
Yeah, because it depends on the class and the market, so it can just vary. Yeah.
Yep. All right. Will the slides be released? I'd like to bookmark the websites you showed, but I couldn't get to all of them.
Yes, I can share the slides.
Yeah, if you just PDF your slides and send them to me, I will link them to your profile, which is going up in the Speaker Hall of Fame.
Oh, nice. Thank you.
All right. And what was the website for the market cycles?
That is called the IRR report. You can pull it up once you just register with them. They have a free PDF that you can download that has the market cycles for all asset classes and different cities.
And Anna Maria just put a link into the chat from census.gov construction /BPS. And I'm assuming this is related to construction permits and building starts.
Yeah, possibly. Yep. Building permit survey.
All right. Do we have data on equality for renters and buyers by city? That's a great question. I don't know.
I don't know either. There is just a lot of free data that can be like explored as per your need. So I guess it's just a matter of going and just researching in these websites as to based on what you want.
Yeah, the website that you pulled up, Justice Map, probably would get you to a lot of this type of information. They have
Right.
a lot of information on demographics and
Yeah.
breakdowns by race and income and things like that.
Right. Yeah.
All right, let's see. Can you
Yeah,
tell
I
us how?
think,
Oh,
sorry.
go ahead.
Oh, I was just gonna make a very generic statement. I mean, like as engineers, we're always looking at data, right? And I think using data for real estate can be very beneficial, in terms of risk versus return. And data is something we use all the time in our jobs, so why not for real estate?
Yeah, specifically, no matter whether you're investing in, single family homes, mobile home
Yeah,
parks,
any asset
commercial
class,
properties,
really. Yeah, because it defines
knowing,
the demand.
let's see. Collins is asking, could you tell us how to differentiate the property classes A, B, and C?
Class A is typically newly built. It has like the high-end gym or spa, and it's like in a very good location. The typical demographic that wants to rent here is for convenience. They don't really need to rent. They can probably own a house, but they rent just for the sake of convenience. They either don't want to deal with maintenance or they want to be closer to work. That's class A, and class B is like it's an older, slightly older, like 1980 build to about 2010, 2000, like it's slightly older. This demographic, they have to rent. They don't necessarily can own, so they choose, like they have to rent. It's more workforce demographic, and the location also is in a slightly not bad, but it's more in a workforce kind of a neighborhood. And class C, it's higher crime rate. The apartments are run down. They're much older. They're like a ton of maintenance issues. So in terms of like risk versus return, class A is the least risky because you have a very stable tenant base who can afford, like more than afford to pay. Whereas class B is moderately risky, but there is much more scope to like renovate the apartments or improve maintenance and increase rents. So the returns are also better in class B. Class C is the extremely risky because like rundown apartments, high crime rate. But if you're able to find an operator who can go turn over the property, like really renovate it, change, and if provided class is also in a good location, they're able to change the tenant base, then you can see like double, triple returns in class C. So in terms of, I hope that gave enough idea.
Yeah, I think that was really good. And I often talk to investors who, love to see a picture of a beautiful house, right? And it's in a great area and they think it's going to be wonderful. And what a lot of people don't realize is that with the class A right there, the reason why it's so wonderful is because it's already been improved.
Yeah.
And which means that if you are looking at it from an investment point of view, there's very little room to improve it and provide a return. And so, a lot of investors look for the ugly house in a nice neighborhood, something they can fix up and improve. That's
Right.
good.
Yeah. Yep.
So don't be fooled by beautiful pictures.
Yeah, the real money lies in the ugly houses in beautiful or good neighborhoods.
Yep. This is an interesting question. How important is the great school rating when analyzing? So how important are school ratings in an area?
I think that depends on like, I think for multifamily, like class B asset class, it's not that important. That's where I focus on for my commercial investments. But for single family, if you're looking at appreciation, then it's good that it's in a good school district. You get higher appreciation.
Yeah, I personally, when I look at great schools, I have never found accurate information there, frankly. So much of it is dependent on, I had a good experience with my own teacher, but maybe the overall school rating was bad, or maybe there are just some people that voted it down on the website. I've never found good schools to be accurate or predictive of anything, really.
Okay, I think in Austin here it's a little bit different. Like, yeah, people look at that a lot for single family at least.
Yeah. And we did too, actually, when we moved to Hillsboro. Hillsboro doesn't have very good great school ratings. I think our school's rated 3 out of 10. But we have had a good experience there.
Okay.
And my kids have done well there. So I'm
okay. Yeah, I think
there's
like
that.
in terms of pricing here, we see at least 100 to 150K difference in like the same 1 mile radius apart houses that are in different school districts. So it's kind of a major factor for single family here.
Yep. Did I miss any questions in there? And if there are any others, feel free to put them in the chat. All right. Do you have your contact information, Manasa?
Yeah. I didn't share that, but it's on the slides. Folks can obviously ping me here. I work at Intel, and you can reach me at on my Facebook page, siliconhillscapitalgroup.com, and also I have a website, and I'm on Instagram.
Awesome. Thank you so much for coming in and sharing with us and all these great links. I'll have the video up hopefully in about a half hour.
Okay, thanks, Daniel, for giving me this opportunity. Thank you, everyone, for attending.
Have a great weekend.
Thank you.
Bye.
Thank you.
Thank you.
Bye-bye.